For most of the modern era, the United States dollar has held a unique position in the global financial order. It serves as the primary reserve currency, the unit of account for international commodities, and the medium for the majority of cross-border transactions. From banks in Frankfurt to energy traders in Singapore, the dollar has been the default. But increasingly, that dominance is being tested in an unexpected way, not through traditional economic decline, but through rapid innovation in the digital plumbing of the financial system. At the core of this transformation is how money moves, not just what currency is used. International transactions do not happen by magic. They rely on a complex infrastructure of communication protocols, clearinghouses, and settlement systems. These systems have historically revolved around American financial institutions and practices, creating a framework that implicitly reinforces the dollar's centrality. Even when two nations conduct business using euros, pounds, or yen, their banks often route the transaction through a dollar clearing intermediary. This underlying structure has long provided U.S. policymakers with strategic leverage. Through control over financial gateways, the United States has been able to enforce sanctions, restrict access to certain markets, and pursue geopolitical objectives without deploying military or diplomatic tools. The Society for Worldwide Interbank Financial Telecommunication, or SWIFT, plays a pivotal role in this system. Though headquartered in Belgium and nominally neutral, SWIFT's cooperation with U.S. sanctions has repeatedly demonstrated its importance to American power projection. However, many of these systems were designed in the last century. SWIFT, for example, celebrated its 50th anniversary 2 years ago. Its model, which separates financial messaging from the actual movement of money, is increasingly seen as outdated in a world of real-time data and integrated platforms. Users today expect speed, transparency, and security, and traditional systems are struggling to meet those expectations. Enter China's Cross-Border Interbank Payment System, or CIPS. Launched in 2015, it offers a more modern alternative, combining both messaging and settlement into a unified platform. While its early adoption was limited, CIPS has steadily expanded. As of 2 years ago, nearly 1,700 institutions across 100 countries had registered to use it. And that number is almost certainly higher now, as new agreements are signed and participation grows. One recent milestone illustrates this momentum. In early 2024, the Central Bank of the United Arab Emirates partnered with China to build a regional payment system tied into CIPS. The initiative is aimed at serving banks across the Middle East and North Africa, many of which are increasingly looking to diversify their financial relationships beyond the dollar and euro. This is not an isolated example. Across Asia, Africa, and Latin America, similar partnerships are emerging, some led by governments, others driven by private banks or technology firms. These shifts are not just strategic. They are also practical. In 2023, Bangladesh used Chinese currency, the renminbi, to repay a Russian contractor for a nuclear energy project. Normally, such payments would have gone through dollar-based channels. But with Russian banks sanctioned and dollar pathways blocked, Dhaka opted for a workaround. While this transaction made headlines, many others go unreported. When payments happen outside the traditional system, they also fall outside the visibility of U.S. regulators. Why is this happening now when alternatives to the dollar have existed for decades? One answer is cost. Until recently, building a rival to systems like SWIFT was prohibitively expensive, both technically and politically. But the rise of blockchain technology, decentralized finance, and digital currencies has changed that. Tools once accessible only to the largest economies are now within reach of middle-income countries. With the right software, even a small central bank can participate in global settlement networks without relying on traditional intermediaries. Another answer is motivation. After Russia's full-scale invasion of Ukraine in 2022, the United States and its allies imposed sweeping financial sanctions. Russian central bank assets were frozen. Its largest commercial banks were cut off from SWIFT. In response, Russia, China, and others accelerated efforts to create alternative channels. These efforts had existed before, but the urgency had changed. What was once seen as a theoretical hedge suddenly became a strategic imperative. Central bank digital currencies, or CBDCs, have emerged as one of the most promising tools in this context. Unlike cryptocurrencies such as Bitcoin, CBDCs are issued by sovereign monetary authorities. They are programmable, traceable, and can be exchanged instantly across borders. As of mid-2025, over 100 countries are exploring or piloting digital currencies, with nearly 24 in advanced testing or early deployment. One of the most ambitious CBDC projects is mBridge. Spearheaded by the Bank for International Settlements, it brings together China, Hong Kong, Thailand, the United Arab Emirates, and more recently, Saudi Arabia. The platform allows central banks to settle cross-border payments using digital currencies, without converting to dollars or relying on US-controlled networks. In its 2022 pilot, mBridge processed only $22 million in transactions, a small amount in global terms. But the project's importance lies not in volume but in architecture. It represents a viable alternative model. For now, most economists and central bankers still believe the dollar's position remains secure. They point out that more than 80% of foreign exchange transactions involve the dollar. It still accounts for roughly 60% of global reserves. No other currency comes close. The Chinese renminbi, for instance, makes up less than 3% of global reserves, and its convertibility is limited by strict capital controls. But this analysis may miss the point. The dollar's strategic power comes not only from its economic weight but from its central role in enforcement. Sanctions work because they limit access to the dollar. Financial pressure is effective because it can cut countries off from essential networks. If those networks evolve or move elsewhere, then the effectiveness of those tools begins to erode, even if the dollar remains dominant on paper. Moreover, perception matters. When countries see others successfully using alternative systems, they become more willing to try them. When institutions are offered faster, cheaper, and more transparent services, they shift naturally. And when major players like China and Saudi Arabia begin to align their infrastructure, the risk of fragmentation increases. Even marginal decreases in dollar reliance can compound over time. To meet this challenge, the United States must update its approach. First, it should work with allies to modernize SWIFT and other global networks, incorporating the kinds of innovations already being adopted elsewhere. Second, it must invest in domestic capabilities. As of 2022, China's central bank had over 300 personnel working on digital currency systems. The U.S. Federal Reserve, by contrast, had fewer than 24. Third, the conversation around digital money needs to shift from purely economic analysis to strategic foresight. Maintaining the dollar's role is not only about interest rates, trade balances, or GDP. It is also about infrastructure, innovation, and trust. A system that cannot adapt will eventually be bypassed, not out of malice but out of necessity. The United States has navigated similar transitions before. Its leadership in global finance has always depended on both scale and innovation. But as history shows, from the fall of the British pound to the rise of the euro, reserve currency status is not a permanent condition. It must be earned and re-earned in each era. What is happening today is not a crisis, but a recalibration. The digital foundations of global finance are being rebuilt. Whether the dollar remains at the center of that new system will depend on what choices are made now.